Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. And Happy New Year, first and foremost, to everyone. And, as I said a few days ago when I put out those, stats on LinkedIn, I really appreciate anybody who spent a little bit of time here, a lot of time here, listened to one, part of one, 10 seconds of one. All consumers of the show so far, thank you. Obviously, without an audience, we can't do that. And we've seen the audience grow quite substantially, in the first 45 or so episodes. And so I appreciate that. And certainly we here at Deal Catalyst appreciate that as we get into, some new products, other than obviously what we're known for, which is conferences of, different sizes and different focuses. And, I can only hope to continue to grow the audience and to at least bring a little bit of fresh and interesting content, your way. So, I really appreciate it. Thank you from the bottom of my heart. And, looking forward to a fun, engaging 2026 with a lot more fun stuff to happen. Hopefully some live shows and, some cool things at the conferences that maybe we can tie into the podcast as well, or as it is becoming known, the Toddcast. So we'll see if we change anything officially, but internally it's called the Toddcast, which is kind of funny from the team. But just a few things I wanted to kind of touch on before we get back into our kind of regular flow of episodes, into the new year is, kind of look at where we're at in a few different areas of, the markets that we cover, which as a reminder are, private credit, the direct lending and ABF pieces, structured credit with our CLO and RMBS events, as well as our Dubai conference, and then fund finance, which has clearly been a growing segment of the market overall, and obviously of our universe. And as we look towards 2026, 2025 was I'd say a bit of an up and down year when looking at these specific markets. I think obviously CLO market and numbers tend to continuously increase, but what is that new issue versus reset and refi? I think you're seeing some things shake out in that market, but I think more specifically, I think the things around private credit have really taken the mantle of the news the last year or so, and some of that being bad news with obviously the First Brands and Tricolor, and we had some news over the holidays with the Tricolor founder facing 20 plus years in prison. But I think when you look at the environment today, for both direct lending and ABF, I think you're certainly getting increased pressure from LPs. A lot of that due to fees, and they're certainly looking to get fees lowered. On top of that, you're getting more interest from LPs to co-invest alongside managers. I think that's in part to keep fees down, obviously carried interest as well. And so I think when it comes to the private credit space, you're seeing some really, really great tailwinds, especially in ABF, but also you're getting some headwinds in the direct lending market. And I think part of that also is coming from the banks themselves as these post GFC restrictions continue to be eased, especially as it comes to what banks need to hold as it relates to the loans they make. I think you're going to start to see greater competition and you're already seeing banks play in private credit through partnerships and through creating platforms themselves. But I think there's the potential, at least according to reports I've been reading the last few weeks, of almost 3 trillion in lending capacity being lifted, from banks, and that gives them the greater ability to continue to compete in the direct lending space. And what does that mean for, funds that have made their business on, being an alternative to bank lenders? So I think it's going to be interesting to see how much banks continue to kind of inch and grow into this space, which we haven't seen a groundswell of. I mean, the Trump administration had signaled over the summer related to the asset ratios and what banks need to hold, in comparison to the loans they make, but there wasn't really this like letting go of the reins and hey, we're going to compete directly in this space. We're going to take back business from private credit funds. You've seen more of a collaborative effort with banks and private credit funds, and I think a lot of that is going to continue. I don't think you're just going to see this complete letting go from banks and jumping into and competing directly for deals with private credit firms. I think just like in the ABF space, banks are going to continue to perform the in the areas in which they've become more comfortable, and that's less consumer and less SME owner focused and more how do I provide capital through a platform, whether it be a fintech lending platform or a direct lending platform from a private credit shop. I think that's where banks are starting to find a more natural footing versus becoming the forward facing, hey, we're going to interact with SMEs again. I mean, the underwriting standards of a bank when it comes to underwriting a private credit shop or underwriting a fintech platform are different than when they're taking the loans themselves, underwriting individual businesses or individual consumers, which they still do some of. But I just don't think we're going to see this wide industry led change of banks flipping and now going back to the front lines where they were 20, 30, 40 years ago. So I think you're going to see more, probably private credit bank tie-ups, partnerships than we have, which I think lends itself to a better balance, given the flexibility of private credit and the capital that they can provide to businesses versus bank-led capital, which is obviously longer, stricter underwriting standards, and ultimately slower capital out the door, which a lot of these businesses in many cases need faster. And they're willing to pay a little bit more as long as they get the money tomorrow or 3 days from now or 4 days from now instead of 3 months or 4 months from now, which in many ways the banks take that long to underwrite. And some of that's probably changed, gotten a bit compressed, and they can do it in a bit shorter time frame. But I just don't think you're going to see a big a big change when it comes to who's lending on the front end. I think I was reading the Going Private newsletter for Bloomberg the other day, and it had some really really interesting sentiments from some of the top firms out there. I think Blair Jacobson, the co-president of Ares, had said 2025, when we're looking at it in the rear view mirror, is probably going to look a lot better than it felt in real time, and that a lot of that has to go with you know the bad news, which even Dan Peters at KKR talked about being kind of a bit overblown, a bit sensationalized by some of the media outlets. And so I think when looking at the numbers and what actually happened in 2025, I think we're going to feel like, all right, it wasn't that bad of a year, which is basically the sentiment coming out of Aries. I think the other thing I found interesting in that newsletter was 100 almost 180 billion in data center credit deals were struck in 2025. And I think when looking at one trend that will continue to dominate the headlines is data center and AI capacity and what will happen in this space. Will it be a bubble as Howard Marks has talked about? What will not only regulatory issues start to happen. Bernie Sanders has called for a moratorium on data centers. Where will the data center growth come from? TikTok recently, I think, struck a deal in Brazil for a $37 billion data center. I think data centers and AI and trying to figure out how to increase production of AI related technology without completely eroding local communities, which I think some has been overblown to begin with. The water supply issue, the power issue, I think is something that will come to a greater head in the future. I think to date, it's been a bit overdone by report or by politicians in order to maybe slow down or adjust where some of these data centers are built. But I think the impact on local economies and local access to either water or power has not yet really reached the tipping point. Eventually, it probably will, especially as more politicians get closer to the issue and what it means for their communities, and how many of these data centers can be built, where can they be built. One thing is clear though is that big tech firms clearly have become more like big tech and debt firms. I think if you look at Meta, Oracle, Google, probably even Microsoft, I think I just saw the top three there. Meta, Oracle, Google, at their debt ratio on their balance sheets has increased, if not 50, then at least 100% over the last 5 years. I mean, Oracle is at the top of that list. And I think I saw something quoted, in one of the newsletters that, their balance sheet looks, drastically different with the amount of debt that they're now holding than upwards of 3 to 5 years ago. And I think there's a reason why their stock is down so much. But also it's seeing how these big tech firms can really handle this shift because they can't just pay out of pocket. Private credit has now stepped um, in a big way. You have the likes of Blue Owl and others raising billions, Mubdala giving billions, other large Middle East allocators giving billions, the Qatari Investment Authority as well. And I think you're going to see that trend continue. Whether or not it turns into a bubble, many people think it will. Some things probably need to shake out there. I think time will tell. I don't think 2026 will necessarily be that time. I think you're going to need to have, a lot more research and a lot more capital go into the space. And I think one thing investors have told me is that, the data center investment, uh, there's a lack of where this plays out, considering how new it still is. And I think that's still a fear amongst investors, especially on longer dated investors. And there's certainly a real concern that technology is still the greatest risk in that space. And will something be created like the DeepSeek that makes some of this data center capacity um, less desirable. I don't think we're there today. I think obviously things are being created, but I think you have the data center build out issue, the technology issue, and then the political local community issue. And I think those three things, I'm not sure, come to a head in 26, but I would venture a guess in the next 3 years they do. But one thing is clear is that the volume of data center deals are not slowing down. Anytime soon. The other, interesting tidbit out of at least the Bloomberg newsletter was, the private assets industry will spend more time cultivating a stronger risk management in 2026. And that comes from James Reynolds, co CEO of Goldman Sachs Asset Management. And I think that plays right into some of the fraud issues that we saw with First Brands and Tricolor in 2025. And I think there's also this growing fear that there's more out there, which lends itself to a certainly a bigger risk along on the market. And I think certainly the sensationalism in the coverage has been due to it can't just be limited to First Brands and Tricolor, and I think there's been a couple of other smaller ones. But clearly, there has been, with this flood of capital into the market, has been a thought that deal terms and covenants have been eroded at least a little bit in order to deploy a lot of the capital that's been raised. And now people will kind of reset a little bit going into 2026 and, be a bit more selective in their choices. And I think selective deal making has certainly been, a common theme I've heard, say, the last 6 to 10, maybe even 12 weeks, that people are just going to become a lot more selective than they have been, which I think lends itself obviously to a different environment, but still a robust one. I mean, if you look at capital raising, it's not slowing down. It is kind of uneven in certain areas, but it certainly doesn't seem to be slowing down overall in the private markets, and I think that's certainly going to continue. The other couple of things I want to touch on before wrapping up as we hit the weekend here is the BDC appeal and where that's certainly taken a big hit, over the last year. If you look at just the numbers, BDCs were down 6% versus 2023, up 25%, 2024, up 14%. And so when you look at that, up 25, up 14, down 6, when the S&P is up, 19%, I mean, it really continues to give investors pause on kind of, is this a blip in the road, or is this product a bit more flawed as private and public markets become a bit more intertwined? Is this where people want to deploy capital, or do they want to deploy it in something that's a bit more understood and a bit more down the fairway in terms of the S&P? Though fundraising obviously is still strong. You have some records being set. But I think the biggest issue facing BDCs, at least from what I've read and what I've understood when talking to investors and BDC shops themselves, is the resetting of expectations. This has been a mid-teens type return, this product, and now it seemingly is headed towards higher single digits, and I think it just comes down to resetting expectations with investors and what they think they're getting when they invest in a product like this. And if investors are comfortable with that risk return, then I think BDCs will continue to perform, and maybe the blip lasts a little bit longer to kind of reset the investor expectations. But obviously, expectations need to be reset, at least today. And then you've also had some other, kind of issues surrounding the space. You had the Blue Owl issue, combining funds and then not combining funds. I think there's some real headwinds facing BDCs. I think more time needs to pass before we take a real hard look at, hey, is this product a long-term answer? But I think today the trends for the BDC space, while very good on the fundraising side, aren't necessarily great when it comes to returns. On the flip side, a market that just seemingly has more and more tailwinds to it is the asset based finance markets. I mean, if you look at the ABS piece of that, unsecured consumer ABS issuance is at record levels. You have private credit firms purchasing more than 100, almost 140 billion in consumer loans, pushing into credit card receivables. Now you're going to start seeing credit cards co-branded with private credit shops. I mean, if you want to say, hey, here's private credit in a couple of different buckets, you have, the typical direct lending, which is obviously related to BDCs. And then you have ABF. I mean, right now, if you're looking at the two side by side, the ABF opportunity seemingly is significantly more appealing, especially with the asset mix. In terms of diversification away from just, your senior secured, upper market, middle market, even lower middle market direct lending. You can go into 20 or 25 different asset classes in ABF, and some of those just continuously have, you know, con an enormous amount of interest and capital being driven into them. And to be frank, I'm a little surprised that consumer is still as popular as it is. I mean, I've been covering and in and around consumer ABS and consumer lending post GFC, and the fact that it's still that appealing to investors and that appealing of a product just shows you that a the consumer is a credit driven consumer, and B, there's just a lot of different types of opportunity in the consumer space, from your unsecured debt consolidation all the way through to buy now, pay later, to home improvement, to home equity investment. I mean, the flavors of consumer clearly point to a pipeline of hundreds and hundreds of billions of dollars. And I think part of the tailwinds to that is, lends it back to kind of where we started a little bit, which is the banks and some of the reins being let off the banks. I mean, lending to non-bank financial institutions accounted for 40% of bank loan growth in 2025. 40%. I mean, that's a pretty big number. And I was still at my previous shop when the number flipped of when, the fintech or non-bank originating platforms became in the aggregate, the bigger lender to consumers than banks. And that just hasn't slowed down. Like I said at the top, I think where banks have become more comfortable playing, I think is where they double down in 2026 and 27 and beyond, versus the reins are free. Let us become the consumer brand. I think they've become more comfortable underwriting a platform or underwriting a private credit fund or underwriting someone else versus the SME or the consumer itself. And I think those trends will only continue as we head into 2026. Um, and so that's kind of where we're at right now. Some things I thought interesting heading into this new year. Obviously, you can see I'm wearing my Bills sweatshirt. Hopefully, they can close out the Ralph or Highmark Stadium as it's now called with a win, and then get on a fun run in the playoffs. And if they do, I think we'll do some special stuff with that. But as a Bills fan, they always get to a certain point and find a way to break our heart. Be hopeful at least that that doesn't happen the playoffs this year. But Happy New Year, everyone. Thanks again for joining us on this journey, and looking forward to continuing to provide some interesting and fun content in 2026 and hopefully beyond. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.